Great to have you on. I was all set up to talk about how bad it's been and how difficult a year we're in, and then there we go. We get a $70 billion merger Monday to kick us off. So look, I think it begs a very obvious question, which is what, if anything, can we read about today's news in terms of next year and the mood going into it?
Oh, good to see you again. And we managed to get at least a couple of our deals announced today, just so we can have a merger Monday. And it's been a good flavor, too. As you said, both in the Horizon deal and the Cooper deal, you had multiple bidders there competing with each other to get to the finish line. Companies that went public who, and their valuations have come down materially, take private transaction. We did a corporate divestiture in Europe. So these themes, I think you're going to continue to see in 23. You were talking earlier about August kind of being the high point. I really think of this year as two halves. The first half was very much in line with the pre-pandemic levels. The second two quarters materially down. It's about 2.3, and I think we'll do 1.4 or so trillion in the second half. And the next year, I expect to be the reverse. So overall flat, but the first half more like the second half of this year, and the second half, hopefully more like the first half of this year, but all in kind of flat.
So M&A will bottom out sometime, I guess, in the middle of next year. But even when it does recover, and even when the appetite clearly does come back, we need the financing markets. And right now, they're not there. When do you see that sort of returning and facilitating the kind of boom we need in M&A to get that robust market back?
Yeah, financing has only been one of the inhibitors, because when you step back and look at it, rising inflation, rising interest rates, war that continues, geopolitical tensions, and the impact, the lasting impact of the pandemic on the consumer, on supply chain, a future of work, future of spending. So these are some pretty meaty questions, and uncertainty is not a good thing for M&A. The VIX has been about 25 or so, whereas pre-pandemic, it was 15. So you little bit need a return to being able to predict what the future is. Otherwise, it takes a pretty courageous buyer. But having said that, I do think it's the best of time for a strategic who is well capitalized, because they are not dependent on financing, and you can just use your balance sheet without putting it at stress and still do deals. Yeah. But for the sponsors, it's really been a little bit of a barbell. Some people who are willing to over-equitize and say, when the financing markets come back, I'll kind of recap it. Yeah. And some who are just risk off, and they're going to wait for the leveraged finance markets to come back. They're going to wait to have more clarity on the future, and figuring out where exactly growth, inflation, interest rates, and unemployment, the Rubiks Cube, lands.
Well, I can understand why a publicly traded company that's looking to buy might be a little hesitant in this environment, because they, of course, have to try to justify that to shareholders at a time where that uncertainty is there. For private equity and other buyers that maybe don't necessarily have that spotlight on them in that same way, does this give them, I guess, more of a leg up? Does this give them more opportunity to come in and swoop up some of these companies?
There is a little bit of an advantage, but I think the same thing gets reversed by the financing markets. Because for strategics who last year maybe felt valuations are too high, I'm actually losing to sponsors, or I'm losing to the IPO market. Yes, you have to justify the deal to your shareholders, but it's still a better buying environment over this past 6 months and the next 12 months, rather than it was in the previous 18 months. For the sponsors, I think it's a little bit of, many people will wait to see that the leveraged finance markets are there, other than the ones that I said. There's about a dozen or so of them who are willing to over-equitize and still do deals.
Clarity is key here in terms of people being willing to engage in transactions. Generally speaking, though, we have this uncertain environment, and we have $70 billion worth of deals to announce on Merger Monday. Those obviously took place in a time that was uncertain. Does the uncertainty that we're seeing drag out the amount of time it takes to get a deal done, or are both sides more incentivized to get it done quickly before things change again?
Yeah, I think in general, sellers, if you're, let's split it up into sellers and buyers. Sellers some people are getting realistic, whereas some people need a bit more time to get realistic, because you're still looking in that rearview mirror and saying, I was just valued at a price that was X high, Y high. And if you look at overall, depending upon the correlation between what was the growth of the company and the profitability of the company, the re-rating has been affected pretty materially by that. If you were all growth, no profitability, you got re-rated pretty severely, 60%, 70%, 80% down. If you were kind of decent growth, decent profitability, you still got re-rated, but a bit less. And so if you're a seller in the bottom category, where you had very high growth and not a lot of profitability, you really have to step back and think, what do I want my future algorithm to be? When do I think I can go public? How much cash do I need? And that takes a little bit of time to wrap your head around. Buyers, the courageous buyer, who is willing to take a bit of risk, they are going in there and doing the deal, and some of the best deals for these buyers will get done over the next 6 months. Most buyers wait to catch the bottom, and that becomes more challenging.
And talk to us about the seller mentality here, because if I'm a seller and I'm looking at my 52-week high, I'm probably a long way off it, and I probably think I have a good shot at coming back to it. Maybe my ego tells me I definitely have a good shot at coming back to it. So how do you get them comfortable with the idea that maybe they're going to sell now and maybe they're going to go for way under that 52-week high?
Yeah. Seller is not proactively putting them up for sale. So if you're a buyer, you want to buy that company, go knock on the door real nice and ask real nice, engage, get to know them. And at the time period when the seller's mindset changes, you want to be right there so that they can engage with you. So many of these deals that happen, there was some driver or motivation. There are those sellers who say, you know what, I can see the world pretty clearly, and today I want to be the first to go out to the market and catch the buyer before some of these buyers have done a large deal and they're going to be offside. So you get all flavors, but the majority of sellers today are still not accepting reality, and the majority of buyers are too greedy, waiting for the bottom.
I was hoping you were going to say we're just going to see a wave of hostiles and force the seller's hands.
Friendly, unsolicited.
That's polite hostile. I have an activist question I just want to obviously plug as well. Our activist conference tomorrow running all afternoon here at Bloomberg. Activists have been such an important component of the overall M&A market going back really a decade now. But I wonder now, with all this uncertainty that Scarlett talked about, how do they play it? How do they get into stocks when you could see this sort of precipitous decline from here on out, even if they have a good idea?
Yeah, that's a really good question, because activism as an asset class has really matured. So now you could no longer say every activist wants the same thing. Right? There are some who are opposing a transaction, like you saw in Coupa, and there are some who are saying, go do a deal, corporate clarity, change the CEO, buy back shares, don't buy back shares. So you see every flavor, and the majority of sectors that they've been targeting, 50% of it is industrials, consumer, and tech.
We only have a couple minutes left here. I am curious about the potential for more cross-border deals, particularly in an environment that I think some people have said has maybe gotten a little bit more stringent, regulatory environment, meaning antitrust, whether it's here or in Europe here. Do you think that that potential antitrust risk could actually be an impediment?
You are absolutely right. I mean, cross-border volumes from its heyday of 2015-16 have come down quite a bit. So if you look at China and Europe outbound, or U.S. as a target, both have come down. Because if you're a U.S. company, you're saying, well, I mean, maybe I'd much rather sell to another U.S. company than take the antitrust risk. My expectation that with the strength of the dollar, U.S. outbound to parts of Europe, and some strong European companies looking again at the U.S., that should come back.